1825 North Gramercy is a 27-unit multifamily asset located in Hollywood. By capturing a massive loss to lease and modernizing the interiors, an investor can nearly double the property's yield. The acquisition price is $5.05 million. Across 27 units, the entry cost is roughly $187,000 per door. This is a classic forced appreciation opportunity. Deploying targeted capital allows an investor to minimize downside risk while aggressively driving up the potential return. Breaking down that $5.05 million price tag reveals a basis of exactly $187,037 per unit, or $351 per square foot. These metrics fall significantly below both current replacement costs and the average trading prices for similar vintage assets across the Hollywood submarket. Acquiring the asset this far below sub-market averages establishes a protected financial margin. That margin safely absorbs the capital expenditures required for the upcoming renovations. Raising $1,470 rents to the 2,217 market rate spikes yield to 7.78%. This drops the gross rent multiplier from 13.06 to 8.65. Beyond the top-line rent increases, the pro forma projections include slashing the operating expense ratio from 44% down to 33%. That 11% reduction is achieved by introducing professional property management and implementing utility billback systems, or RUBS. By compounding that aggressive top-line rent growth with strict bottom-line expense reductions, an owner will drastically accelerate the asset's overall net operating income. Location supports this aggressive operational strategy. Gramercy sits in a designated walker's paradise, immediately adjacent to major transit corridors, dining, and Hollywood nightlife. The physical structure is a 1920s-era building, offering 14,400 rentable square feet. It's tightly packed onto a 13,000-square-foot lot, maximizing urban density. The building retains the architectural bones necessary for a high-end vintage renovation, the exact aesthetic that caters to the high-earning tech and entertainment workforce living in this submarket. That combination of a premium, transit-friendly location and inherent vintage appeal provides the financial justification for the heavy capital expenditures required to hit top-of-market rents. This project is engineered for an investor with a 3 to 5 year hold horizon. The ideal operator specializes in aggressive tenant turnover and interior unit modernization. Executing this playbook transforms an underperforming 4.25% asset into a stabilized 7.78% yield. Once stabilized, it provides the owner with a highly profitable exit or a